Question 1. The South Carolina Director of Insurance is responsible for all of the following except: A. Examining insurers' financial condition. B. Enacting insurance laws. C. Issuing certificates of authority to insurers. D. Approving insurance policy forms for use in South Carolina. Answer: B. Enacting insurance laws. The South Carolina Director of Insurance primarily enforces and regulates existing insurance laws, but they do not create or enact new laws. That power rests with the state legislature. The director's role involves overseeing the industry, which includes examining insurers, licensing agents, approving products, and protecting consumers. For instance, if an insurer wants to offer a new type of life insurance policy in South Carolina, it must first be approved by the Department of Insurance, but the underlying statutes governing insurance operations are established by lawmakers. Remember, regulators enforce, while legislators legislate. Question 2. A life insurance policy in South Carolina must include a free look provision that allows the policy owner to return the policy for a full refund of premium within how many days of delivery? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In South Carolina, like most states, a life insurance policy must include a free look period, commonly known as a right to examine period, which grants the policy owner 10 days from the date of policy delivery to review the contract and return it for a full refund if they are not satisfied. This provision ensures consumers have adequate time to understand their purchase and are not pressured into keeping a policy they don't want. For example, if a policy is delivered on June 1st, the policy owner has until the end of June 11th to return it for a refund. Always tell your clients about this important right at policy delivery. Question 3. Under South Carolina law, an insurer offering individual life insurance policies must provide a grace period of at least how many days for the payment of any premium due? A. 7 days. B. 15 days. C. 31 days. D. 60 days. Answer: C. 31 days. South Carolina law mandates that individual life insurance policies include a grace period of at least 31 days for the payment of premiums. This means that if a policy owner misses a premium payment on its due date, the policy will remain in force for an additional 31 days, allowing time for payment without the policy lapsing. For instance, if a premium is due on January 1st and isn't paid, the policy coverage continues until February 1st, after which it could lapse if payment is still not received. The grace period is a critical safeguard against accidental policy lapse due to a slight delay in payment. Question 4. Which of the following is considered an unfair trade practice known as twisting in South Carolina? A. Misrepresenting policy terms to induce a policyholder to lapse a policy and purchase a new one. B. Offering a prospective client a portion of the agent's commission as an inducement to buy a policy. C. Making false statements about the financial condition of another insurer. D. Discriminating against individuals in the same class based on their race or religion. Answer: A. Misrepresenting policy terms to induce a policyholder to lapse a policy and purchase a new one. Twisting is an illegal unfair trade practice where an agent misrepresents policy terms or benefits of an existing policy to induce a policyholder to surrender, lapse, or forfeit their current policy to purchase a new one with the same or a different insurer, often to the policyholder's detriment. This deceptive practice is designed to generate a new commission, and it is distinct from rebating, offering part of commission, defamation, false statements about another insurer, or discrimination, treating similar risks differently based on protected characteristics. Always prioritize the client's best interest over personal gain to avoid unethical practices like twisting. Question 5. In South Carolina, for how long must an agent keep records of all transactions pertaining to insurance policies? A. 1 year. B. 3 years. C. 5 years. D. 7 years. Answer: C. 5 years. South Carolina regulations require insurance agents to maintain records of all insurance transactions for a minimum of 5 years. This record-keeping requirement helps ensure accountability, facilitates regulatory oversight, and allows for proper review of business practices. For example, if an agent sells a life insurance policy in 2023, they must retain all related documents, such as applications, policy forms, and disclosure statements, until at least 2028. Always treat record retention as a serious professional obligation. Question 6. All of the following are typically characteristics of a modified endowment contract, MEC, in South Carolina, except A. It fails the 7-pay test. B. Policy loans are subject to taxation. C. Death benefits are fully taxable. D. Withdrawals are taxed on a LIFO basis. Answer: C. Death benefits are fully taxable. A modified endowment contract, MEC, is a life insurance policy that fails the 7-pay test, meaning premiums paid exceed a certain limit within the first 7 years. While MECs offer tax-deferred cash value growth, withdrawals and loans are subject to taxation on a last-in, first-out, LIFO, basis and may incur a 10% penalty if taken before age 59 and a half. However, even with a MEC designation, the death benefit paid to the beneficiary remains tax-free, just like any other life insurance death benefit, making death benefits are fully taxable the incorrect statement. Understand that the tax implications of a MEC primarily affect living benefits, not the death benefit. Question 7. Which non-forfeiture option allows the policy owner to use the policy's cash value to purchase a single premium policy of the same type as the original policy, but for a reduced face amount? A. Cash surrender value. B. Extended term. C. Reduced paid up. D. Automatic premium loan. Answer: C. Reduced paid up. The reduced paid-up non-forfeiture option allows a policy owner to use the accumulated cash value of a permanent life insurance policy to purchase a new, fully paid-up permanent policy with a reduced face amount. The new policy's coverage continues for the rest of the insured's life, and no further premiums are required. For instance, if a policy owner has a $100,000 whole life policy but can no longer afford the premiums, they could use the cash value to convert it into a $30,000 paid-up whole life policy. This option is ideal for those who want to maintain lifelong coverage without further premium obligations. Question 8. In South Carolina, the minimum required grace period for group life insurance policies is typically A. 15 days. B. 30 days. C. 31 days. D. 45 days. Answer: C. 31 days. Similar to individual policies, South Carolina law generally mandates a grace period of at least 31 days for group life insurance policies. This provision ensures that coverage for group members does not immediately terminate if the policyholder, typically an employer, delays a premium payment. For example, if a company's group life premium is due on the 5th of the month and they pay on the 20th, coverage remains in force for all employees during that time. The 31-day grace period provides a critical buffer, preventing immediate lapse of coverage for a large number of individuals. Question 9. An individual covered by a group life insurance policy in South Carolina loses their employment. Within how many days must they typically exercise their right to convert their group coverage to an individual policy without evidence of insurability? A. 10 days. B. 15 days. C. 31 days. D. 60 days. Answer: C. 31 days. In South Carolina, as in many states, individuals covered by a group life insurance policy have the right to convert their group coverage to an individual policy if their employment terminates, provided they do so within 31 days of losing coverage without requiring evidence of insurability. This conversion privilege is crucial because it ensures continuity of coverage for employees who might otherwise lose their insurance and be unable to obtain new coverage due to health reasons. For example, if an employee's group coverage ends on June 30th due to job loss, they have until July 31st to apply for an individual policy under this conversion right. Question 10. Which settlement option provides a beneficiary with a guaranteed income for the remainder of their life, regardless of how long they live? A. Fixed period installment. B. Fixed amount installment. C. Interest only. D. Life income. Answer: D. Life income. The life income settlement option provides the beneficiary with a guaranteed income stream for the rest of their life, irrespective of how long they live. While the total payout may vary based on the beneficiary's longevity, the income is guaranteed for their lifetime, offering maximum protection against outliving the funds. For example, a surviving spouse might elect this option to receive a steady monthly payment for as long as they live, providing financial security. Understand that this option guarantees income for life, but not necessarily a specific total amount, unlike options like fixed period or fixed amount. Question 11. Which of the following statements about life insurance policy loans in South Carolina is true? A. Policy loans must be repaid by the policy owner before the policy can be surrendered. B. If a policy loan is outstanding at the time of the insured's death, the death benefit will be reduced by the loan amount. C. Interest on policy loans is tax-deductible for the policy owner. D. Policy loans are considered withdrawals and are always taxable income. Answer: B. If a policy loan is outstanding at the time of the insured's death, the death benefit will be reduced by the loan amount. Policy loans utilize the cash value of a permanent life insurance policy, and if there is any outstanding loan balance, including accrued interest, at the time the insured dies, that amount is simply subtracted from the death benefit paid to the beneficiary. Policy loans are not taxable income because they are considered a loan against the policy's cash value, not a distribution. For example, if a $100,000 policy has an outstanding loan of $10,000, the beneficiary would receive $90,000 upon the insured's death. Always advise clients that policy loans reduce the ultimate death benefit. Question 12. Under South Carolina law, what is the primary purpose of the incontestability clause in a life insurance policy? A. To prevent the insurer from denying claims after a specified period due to misstatements in the application. B. To allow the insurer to contest claims if the insured committed fraud. C. To ensure that the policy owner can change beneficiaries at any time. D. To guarantee that policy loans are always available to the policy owner. Answer: A. To prevent the insurer from denying claims after a specified period due to misstatements in the application. The incontestability clause is a standard life insurance provision in South Carolina, as in most states, that prevents an insurer from denying a claim based on misstatements made in the application after the policy has been in force for a specific period, typically 2 years. This clause protects beneficiaries by ensuring that legitimate claims will be paid, even if minor inaccuracies were present in the initial application, although it generally does not apply in cases of outright fraud. For example, if an insured passes away 3 years after policy issuance and a minor health detail was omitted from the application, the insurer generally cannot contest the claim. It essentially creates a statute of limitations for the insurer to dispute the policy's validity. Question 13. Which rider, if added to a life insurance policy, would pay a monthly income to the insured in the event of total disability? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium with disability income rider. D. Child term rider. Answer: C. Waiver of premium with disability income rider. The waiver of premium with disability income rider is designed to protect the policy owner in the event of total disability, not only by waiving future premium payments but also by providing a monthly income benefit. This rider ensures that the policy remains in force while the insured is disabled and unable to work, offering vital financial support in addition to premium relief. For instance, if an insured becomes totally disabled, this rider would cover their policy premiums and provide them with a set income each month. Remember that standard waiver of premium only waives premiums, but this enhanced rider also provides an income. Question 14. What does the consideration clause in a life insurance policy primarily represent? A. The insurer's promise to pay the death benefit. B. The policy owner's payment of premium and the statements made in the application. C. The process by which the policy can be assigned to another party. D. The period during which the policy can be returned for a full refund. Answer: B. The policy owner's payment of premium and the statements made in the application. In a life insurance contract, the consideration clause outlines what each party gives up in exchange for the contract. For the policy owner, consideration consists of the initial premium payment and the truthfulness of the statements made in the application. For the insurer, their consideration is the promise to pay the death benefit upon the insured's death. Think of consideration as the value exchanged between the parties, confirming the contract is legally binding. Question 15. In South Carolina, the term viatical settlement provider refers to an entity that A. Issues life insurance policies to individuals who are terminally ill. B. Negotiates the sale of a life insurance policy from a policy owner to a third party. C. Enters into a viatical settlement contract with a viator to purchase a life insurance policy. D. Provides counseling services to individuals considering selling their life insurance policies. Answer: C. Enters into a viatical settlement contract with a viator to purchase a life insurance policy. A viatical settlement provider in South Carolina is a licensed entity that directly purchases a life insurance policy from a viator, the policy owner, usually someone with a terminal illness, for a cash sum less than the full death benefit. They then typically become the new policy owner and beneficiary, responsible for future premiums, and collect the full death benefit when the insured dies. This process allows terminally ill individuals to access a portion of their death benefit while still living, offering financial relief during a difficult time. Understand that a provider directly buys the policy, whereas a broker might facilitate the transaction. Question 16. All of the following are typically tax-deductible for the individual policy owner of a life insurance policy in South Carolina, except A. Premiums paid for individual life insurance. B. Interest earned on policy dividends that are left to accumulate. C. Death benefits received by a beneficiary. D. Policy loan interest, in certain business contexts, not for individual policy owners. Answer: A. Premiums paid for individual life insurance. Generally, premiums paid for individual life insurance policies are not tax-deductible for the policy owner. While the cash value grows tax-deferred and the death benefit is usually tax-free to the beneficiary, the premiums themselves are considered a personal expense. For example, if an individual pays $1,000 annually for a whole life policy, they cannot claim that $1,000 as a deduction on their income tax return. Remember this key point: personal life insurance premiums are not deductible. Question 17. An agent in South Carolina collects the initial premium from an applicant and issues a conditional receipt. Which of the following statements is true regarding coverage? A. Coverage is guaranteed to begin immediately. B. Coverage begins on the application date, provided the applicant is found insurable. C. Coverage begins only after the policy is delivered and accepted by the policy owner. D. Coverage begins on the date of policy issue, regardless of insurability. Answer: B. Coverage begins on the application date, provided the applicant is found insurable. When a conditional receipt is issued in South Carolina, and the initial premium is collected, Coverage typically begins on the date of the application or the date of the medical exam, whichever is later, provided the applicant is found to be insurable according to the insurer's underwriting rules. This means that if the applicant passes underwriting, they have coverage dating back to the application, even if the policy hasn't been formally issued yet. If the applicant is found uninsurable, no coverage exists, and the premium is refunded. This receipt provides interim coverage and helps protect the applicant during the underwriting process. Question 18. Which life insurance policy provision ensures that the statements made by the applicant in the application are considered representations, not warranties? A. Entire contract clause. B. Insuring clause. C. Misstatement of age/gender clause. D. Incontestability clause. Answer: A. Entire contract clause. The entire contract clause stipulates that the life insurance policy and the application, if attached, constitute the entire contract between the policy owner and the insurer. This means that nothing outside of these documents can be used to alter or dispute the contract. Crucially, it also generally states that all statements made by the applicant in the application are representations, statements believed to be true to the best of one's knowledge, not warranties, statements guaranteed to be absolutely true, which protects the policyholder from minor unintentional misstatements leading to policy voidance. For example, if an agent makes a verbal promise not included in the written policy, it's not part of the legal contract. Question 19. A life insurance policy's cash value growth is generally A. Taxable annually as it accumulates. B. Tax deferred until withdrawn or surrendered. C. Tax-free, similar to the death benefit. D. Taxable only if the policy is designated as a MEC. Answer: B. Tax deferred until withdrawn or surrendered. The cash value accumulation within a permanent life insurance policy generally grows on a tax-deferred basis, meaning that the interest or earnings on the cash value are not taxed annually as they accrue. Taxation only occurs when the policy is surrendered, or if withdrawals are taken that exceed the premiums paid, or if the policy becomes a modified endowment contract, MEC, and funds are accessed. For instance, an individual's whole life policy cash value could grow significantly over decades without generating a yearly tax bill. This tax deferral is a significant benefit of permanent life insurance. Question 20. What is the main purpose of the conversion privilege in a group life insurance policy? A. To allow the group policyholder to convert the policy to an individual policy if the group size falls below minimum requirements. B. To allow an individual group member to convert their coverage to an individual policy without evidence of insurability upon termination of employment. C. To convert term life insurance coverage to whole life insurance coverage within the group. D. To allow a beneficiary to convert the death benefit into an annuity upon the insured's death. Answer: B. To allow an individual group member to convert their coverage to an individual policy without evidence of insurability upon termination of employment. The conversion privilege in a group life insurance policy is a crucial right that allows an individual covered under a group plan to convert their group coverage to an individual policy upon termination of employment or group membership, without having to prove their insurability. This ensures that individuals who may have health issues that would prevent them from getting new insurance can maintain coverage. For example, if an employee leaves their job, they can convert their portion of the group life policy into their own individual policy within a specified timeframe, usually 31 days. This protects individuals from losing their coverage if they change jobs. Question 21. Which type of life insurance policy offers the policy owner the most control over premium payments and investment choices, with cash value fluctuating based on investment performance? A. Whole life. B. Universal life. C. Variable life. D. Term life. Answer: C. Variable life. Variable life insurance policies offer the policy owner the most control over investment choices because the cash value is invested in a separate account, which typically includes sub-accounts similar to mutual funds. The cash value and death benefit can fluctuate significantly based on the performance of these chosen investments, meaning the policy owner bears the investment risk. Unlike whole life, which has guaranteed cash value growth, and universal life, which offers flexible premiums but usually a guaranteed minimum interest rate, variable life requires the policy owner to make investment decisions. Due to the investment component, agents selling variable life products must hold both a state life insurance license and a FINRA securities license. Question 22. In South Carolina, if a life insurance policy lapses due to non-payment of premium, which provision allows the policy owner to reinstate the policy? A. Grace period. B. Non-forfeiture options. C. Reinstatement clause. D. Assignment clause. Answer: C. Reinstatement clause. The reinstatement clause in a life insurance policy allows a policy owner to restore a lapsed policy to its original condition, provided certain requirements are met, such as paying all back premiums with interest, proving insurability, and repaying any outstanding policy loans. This provision offers a second chance to continue coverage without having to purchase an entirely new policy. For instance, if a policy lapsed a few months ago, the owner could apply for reinstatement, which is typically available for a period of 3 to 5 years after lapse. Question 23. An individual purchases a life insurance policy in South Carolina and names their adult child as the irrevocable beneficiary. Which of the following is true regarding this designation? A. The policy owner can change the beneficiary at any time without the child's consent. B. The policy owner needs the child's written consent to change the beneficiary or access the cash value. C. The child can only receive the death benefit if they are alive at the time of the insured's death. D. The policy automatically terminates if the child dies before the insured. Answer: B. The policy owner needs the child's written consent to change the beneficiary or access the cash value. When a beneficiary is designated as irrevocable, their rights are vested, meaning the policy owner cannot change the beneficiary, assign the policy, or access the cash value, example through loans or surrenders, without the irrevocable beneficiary's written consent. This type of designation provides maximum security for the beneficiary, as their interest in the policy cannot be unilaterally altered by the policy owner. For example, if the parent later decides they want to name a different child or take a policy loan, they would first need the consent of the irrevocably named child. Question 24. A life insurance producer in South Carolina is found to have engaged in rebating. What does rebating primarily involve? A. Charging a higher premium than allowed by the insurer. B. Offering a prospective client a portion of the agent's commission as an inducement to purchase a policy. C. Making defamatory statements about a competitor's financial standing. D. Misrepresenting the terms of a policy being sold. Answer: B. Offering a prospective client a portion of the agent's commission as an inducement to purchase a policy. Rebating is an illegal practice in South Carolina, and most states, where an agent offers a prospective insurance buyer something of value not specified in the insurance contract as an inducement to purchase a policy. This most commonly involves giving back a portion of the agent's commission or offering other valuable gifts. For example, an agent offering to pay the client's first month's premium out of their own pocket would be considered rebating. Rebating is prohibited because it can lead to unfair competition and potentially discriminatory practices among policyholders. Question 25. What is the primary purpose of the South Carolina Life and Health Insurance Guaranty Association? A. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurance company. B. To regulate the insurance industry and enforce insurance laws in South Carolina. C. To provide low-cost life insurance to residents who cannot afford standard policies. D. To educate consumers about various life insurance products available in the state. Answer: A. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurance company. The South Carolina Life and Health Insurance Guaranty Association is a state-mandated entity designed to protect policy owners, insureds, and beneficiaries from financial losses if a life or health insurance company becomes insolvent. This safety net ensures that eligible claims, up to specific limits set by state law, will still be paid even if the insurer goes out of business. It is funded by assessments against all solvent insurance companies operating in South Carolina, not by taxpayer money. Always remember that the Guaranty Association acts as a vital layer of consumer protection for insurance policyholders in the event of an insurer's financial failure.